Assalamualaikum and good morning everyone. Today our group will be presenting the impact of COVID-19 on Mr. DIY Group and Berhad, including its financial performance, challenges faced and recovery strategies. Today, I will be presenting the introduction of our study on the impact of COVID-19 on Mr. DIY Group and Berhad. Mr. DIY was established in 2005 and has become one of the largest home improvement retailers in Malaysia. The company offers a wide range of products including hardware, electrical items, stationery, toys and household accessories. During the COVID-19 pandemic, the retail industry faced many challenges due to movement control orders (MCOs), supply chain disruption and changes in consumer purchasing behavior. These challenges also affect the operation and performance of Mr. DIY. Therefore, this study aims to evaluate the financial and operational impact of the pandemic on Mr. DIY. We also examine the strategy implemented by the company to maintain its business operation and support its recovery. The study focused on two periods, 2020 to 2021, which represent the peak of the pandemic, and 2022 to 2024, which represent the post-pandemic recovery phase. Through this analysis, we hope to get a better understanding of Mr. DIY's resilience and ability to adapt to changing market conditions. That's all for me. I will pass this to next presentation. Thank you.
Next, we will discuss about the financial performance of Mr. DIY during the COVID-19 pandemic. The COVID-19 pandemic created significant financial and operational challenges for Mr. DIY Group and Berhad. During the MCO period, many outlets were temporarily closed and customer traffic decreased drastically. As a result, the company recorded a 24.6% decline in same-store sales growth and revenue also dropped compared to the previous year. Besides that, the company had to bear additional operating costs such as PPE, sanitization, and SOP compliance. Mr. DIY also faced supply chain disruptions, which caused delay in product restocking and inventory shortage. At the same time, the increase in online shopping forced the company to strengthen its digital capabilities to remain competitive in the retail industry. That's all from me. Thank you.
This slide, I will present the financial performance of Mr. DIY Group and Berhad from 2020 until 2024 based on its income statement analysis. Firstly, the company's revenue showed a consistent upward trend throughout the study period. Revenue increased from 2.56 billion ringgit Malaysia in 2020 to 4.65 billion ringgit Malaysia in 2024. This significant growth was mainly driven by the expansion of retail outlets, increased customer traffic, and strong demand for affordable household products. The company's continuous increase in revenue indicates that Mr. DIY successfully maintained its business growth despite the challenges caused by the COVID-19 pandemic. Secondly, gross profit also increased steadily from 1.39 billion ringgit Malaysia in 2021 to 1.98 billion ringgit Malaysia in 2023. This shows that the company was able to manage its cost of goods sold efficiently while maintaining strong sales performance. The improvement in gross profit was supported by better cost control, operational efficiency, and the normalization of freight and logistic costs during the post-pandemic period. Lastly, net profit increased from 337.16 million ringgit Malaysia in 2020 to 568.9 million ringgit Malaysia in 2024. This indicates that Mr. DIY managed its operating expenses effectively while continuing to generate higher profits. Overall, the company's income statement demonstrates strong profitability and sustainable business growth throughout the study period. Moving on to the second slide, I will discuss the balance sheet and ratio analysis of Mr. DIY Group and Berhad. Based on the balance sheet analysis, total assets increased from 2.7 billion ringgit Malaysia in 2021 to 3.8 billion ringgit Malaysia in 2024. At the same time, shareholders' equity also increased significantly from 1.15 billion ringgit Malaysia to 1.94 billion ringgit Malaysia. This growth reflects the company's strong financial position and its continuous investment in business expansion and operational development. Next, the ratio analysis shows that Mr. DIY maintained a healthy liquidity position throughout the study period. The current ratio increased from 2.01 in 2021 to 2.38 in 2024, indicating that the company had sufficient current assets to meet its short-term obligations. In terms of profitability, the return on equity, or ROE, remained high, ranging from 29.4% to 37.6%. This suggests that the company effectively utilized shareholders' funds to generate profits and create value for investors. Furthermore, the debt-to-equity ratio decreased from 1.35 in 2021 to 0.96 in 2024. This declining trend indicates that Mr. DIY became less dependent on debt financing and strengthened its capital structure over time, resulting in lower financial risk. In conclusion, Mr. DIY demonstrates strong liquidity, profitability, and solvency throughout the study period. The company remained financially resilient during the after and the COVID-19 pandemic and is well positioned to achieve sustainable growth in the future. That's all from me. I'll pass to the next person.
Assalamualaikum and good morning everyone. Next, I will explain my part, which is Mr. DIY response during the COVID-19 pandemic. First, the company strengthened its digital platform and partner with Shopee and Lazada to maintain sales during movement restriction. Secondly, Mr. DIY improved cost and inventory management to reduce the impact of supply chain and increase efficiency. The company also implemented strict health and safety measures, including sanitization and social distancing to ensure safe store operation. So, in addition, Mr. DIY continue expanding by opening new outlets across Malaysia. As a result, revenue increased from 2.25 billion in 2019 to 2.26 billion in 2020, while net profit rose from RM 317 million to 337 million. So, in conclusion, this strategy helped Mr. DIY remain resilient and continue growing despite the challenges of the pandemic.
Assalamualaikum everyone. Today I will take you through our strategic recommendation to ensure Mr. DIY Group maintains its corporate resilience and competitive advantage against future micro shocks. To maintain long-term resilience against future micro shocks, Mr. DIY must optimize its finances by establish a dynamic cash reserve policy, a 90 to 120-day operational cash buffer, and adapting a debt maturity laddering strategy using fixed rate long-term financing to secure solvency. Operationally, the company should pursue geographical and vendor diversification across ASEAN to mitigate China-reliant supply chain shocks, alongside warehouse automation via AGVs and AI-driven WMS to reduce labor dependency and since real-time stock. Finally, strategic stability can be achieved by diversifying the brand portfolio, accelerating Mr. Dollar and Mr. Toy to hedge against its inflation, and formalizing an ERM framework under a permanent crisis management commit to proactively manage future risks through biannual stress testing. So, let's move to the next part. To wrap things up, Mr. DIY has shown incredible resilience over the last few years. Instead of just cutting costs during the crisis, management took a bold approach by investing heavily in digital growth and protecting the business. The numbers really speak for themselves. Revenue grew massively from RM2.56 billion in 2020 to RM4.65 billion in 2024, and net profit stabilized at a strong RM568.90 million. At the same time, they completely strengthened the balance sheet. They nearly doubled their current ratio to 2.38 and brought their debt to equity ratio down below 1.0, ensuring long-term financial health. A big part of this success was how fast they adapt. When the pandemic first hit and same-store sales dropped by over 24%, they immediately shifted online to Shopee, Lazada and their e-commerce platform to capture lockdown demand. Ultimately, Mr. DIY gave us a masterclass in strategy. They proved that surviving a major crisis is not about hiding or cutting back. It's about smart capital investment, digital execution, and having the foresight to plan ahead. So, that's all from us. Thank you.